Last time we spoke, I admitted to you that I was finally concerned about the stock market. Not concerned by the cliche recession and depression that so many other influencers out there have been calling for the last couple of years, but concerned that the economy is going to overheat and the stock market is going to form a bubble. It's going to melt up, which, yes, is very good on paper. We can make a lot of money in a short amount of time. That's exactly what I plan on doing today. The problem is when that bubble pops or the market ends up melting down after the melt up. And it's really, really difficult to try and time the tops and bottoms. As I always say, it's best to buy undervalued companies and hold them until they become overvalued, regardless of any sort of market correction, crash, rally, skyrocket, whatever you want to call it. The best plan is always to stay invested, buy things that you think are undervalued, and sell them when you think they're overvalued. But today I'm going to admit that my concern for this has actually increased as a result of the Federal Reserve's recent decision to cut interest rates by 0.5% rather than 0.25%. And to start this video, I want to show you a tweet. This is some economic data that bears and hardlanders won't ever show you. And this is updated data. This is recent economic data. Real GDP grew 3.0% in Q2. Here's a state-by-state breakdown. I live in Nebraska. GDP growth in my state was hot, man, 5.3%. Personal incomes increased $315 billion, or 5.3% in quarter two. Here's a state-by-state breakdown of that. Again, Nebraska running hot, 6.6% growth. Corporate profit margins were revised higher to 13.16% in Q2. That's seen on this chart here, which is an all-time high that we've only seen once previously, back in 1950. Initial unemployment claims continue to fall and normalize, which means layoffs remain historically low. And real disposable personal income growth was also revised higher from 1% to 2.4%, which means the personal savings rate saw a significant upwards revision to 5.2% in Q2 as a result. Now, I just said a bunch of different words, but my point here is the Federal Reserve and so many other people in the markets right now have been claiming that the federal funds rate is restrictive. And I disagree completely with this, and this is why I'm concerned that the economy is going to overheat as a result of the Fed stimulating an already warm or hot economy. And none of this data here says that the federal funds rate is restrictive. GDP growth at 3.0%. GDP, our country's GDP is at an all-time high. How is that restrictive? How does that tell us that the federal funds rate is restrictive right now? Personal income's growing. Corporate profit margins being at all-time highs. Initial unemployment claims falling. Disposable personal income growth. None of this tells us that the federal funds rate is restrictive right now. And we can look at a ton of different charts on the federal funds rate and see that the abnormality with the federal funds rate is not the 5% that it's sitting at today, but instead it's the 0% or free money policy that we've experienced largely since the 2008-2009 financial crisis. That was the abnormality. Today, 5% is not the abnormality, yet the Federal Reserve and all these other investors out there think that it is and that the federal funds rate needs to come down. Otherwise, we're going to see this massive recession. Keep in mind, they've been saying this for 2+ years now, and all they've been is wrong. So based on this data, along with a lot of other data that I didn't even include in this tweet, our economy is in a very healthy place. It's growing at an above average pace, and all of this is taking place as most of the rest of the global economy has actually struggled. The United States economy has been very unique in that it's been strong throughout all of this. A lot of other central banks around the world have been cutting interest rates and stimulating their economies for a long time now because their economies have been struggling and they have been trending towards recession, unlike the United States of America. But now that the Federal Reserve in the U.S. has declared victory on inflation and is set to continue to cut rates and stimulate the economy, and it's really only a matter of how much they're going to press the gas pedal on this, they're going to cut rates. That's a fact of the matter right now. And that's what concerns me. I really don't think our economy or our stock market that's at all-time highs right now needs the extra push at its back that cuts to the federal funds rate would give us. To put this another way, the United States economy has done very well despite the global economy being a headwind for our own economy. Now that we've joined the monetary policy easing club, we have to consider what's going to happen now that we're trying to drink from the global monetary policy fire hose. That's the best way to put it. All of this money is coming into the system and the global economy, and all of a sudden, the biggest economy in the world has joined the rate cut party and the monetary easing party. And I've said it previously, it's not just the Federal Reserve that's stimulating the economy, it's also the Treasury Department, who is borrowing at the short end of the yield curve to buy long-term treasuries, which means long-term interest rates are going to be held lower, which is stimulative to the economy. But also, no matter who's elected this November, Trump or Kamala Harris, they have a reckless spending policy where the federal budget deficit will widen, which will be inflationary, which will actually boost economic growth. So you have the three different major areas of the economy, the United States economy, that are set to stimulate over the next, let's call it 4 years. And I don't think the Federal Reserve is really considering that, if the next president of the United States causes reinflation, our credibility at the Federal Reserve, it might come under fire because we're cutting interest rates going into this environment where nothing really tells us we need it right now. And what's really confusing to me, we've already shown that GDP growth in Q2 was above 3%, which is the average over time. What confuses me is we can look at the Federal Reserve's summary of economic projections and see that for some reason, they're forecasting GDP growth to be 2.0%, which is below average as they're cutting interest rates and stimulating the economy. Something here just does not add up to me. I really refuse to believe the Federal Reserve is this blinded, but maybe they are. Maybe Powell really wants to retire and cement his legacy as a good one as the Federal Reserve president. But this doesn't make sense to me. The federal funds rate, we can see in this summary of economic projections as well, they project that the federal funds rate will come down to 2.9% over the next 2 years, which is incredibly low. But over the same time period, they say that GDP growth is only going to be 2.0%. And we've already averaged 3.0% despite no stimulation from the Federal Reserve to the economy. This is really what's adding up to our economy could very well overheat in the next few years. And again, that's the problem with a bubble or a market meltup. You don't know how long it's going to last. Things can get so crazy that when we look back on it after the crash or the correction, why were we so stupid? Why did we keep buying stocks during that time period? That was ridiculous. And that could be what happens. It's almost impossible to time the top of the market. And if you don't time the top of the market and you're a short-term minded investor, you're going to lose a lot of money. I have a feeling a lot of you that are watching this video experienced the bear market of 2022. That was painful. And if you didn't experience it, just consider yourself lucky. And ultimately, if this bull market makes the 2021 bull market look small, the 2025, 2026, 2027, whenever the bear market hits, that will also make the 2022 bear market look small. It's just math. And this just seems crazy to me. The markets right now, the futures market, anticipates the federal funds rate going down to 2.9% or below 3% by August of next year. By August of next year, they expect the federal funds rate to fall by more than 2% over the next 12 months. And I see nothing in the data that supports we need this stimulation in our economy. We talked about unemployment and initial unemployment claims earlier, how they have been falling, and it's done this for the last few years. It rises during the summer months and then cools off towards the end of the year. It's doing the same exact thing today, and this means that layoffs remain muted. A lot of people will point to the unemployment rate rising to, 4.3% right now or something like that, and they say, wow, the labor market is cooling. It's getting recessionary. We need to cut interest rates before this gets out of hand, because once the unemployment rate starts to creep higher, all of a sudden it skyrockets and it's too late. And yes, that's been the case historically, but this time is different than ever, because if you look at layoffs data, whether that's via the JOLTS report or the Challenger data, whatever you look at, layoffs remain muted. Layoffs remain close to record lows. The reason the unemployment rate is rising is not because people with jobs are losing their jobs. It's because of an increase in labor supply, primarily as a result of immigration and maybe even illegal immigration. And if we really think about the United States economy, I'm not blinded. I will admit to you, even though I'm bullish on the economy and I'm bullish on the stock market, there are weak areas of our economy, but that's normal. That is normal. There should be weak areas of our economy. Things get overstretched and need some correction. Tech valuations need to get slashed at some point. Things have to normalize to pre-pandemic levels, and a lot of things still have yet to do so. The one area of our economy that's felt a lot of pain, and you can look at the data and see it, it's the goods sector of the economy. Whether it's production, consumption, investment, employment, whatever it is, the goods sector of our economy has struggled. That's for a lot of different reasons that we've talked about on this YouTube channel, but it also means that a lot of people's recession indicators are misleading because they miss the entire point. I've talked about this endlessly on this YouTube channel, but I can't talk about it enough. The goods sector of our economy today is very, very small compared to the services sector, and that is flipped from the 1950s, where in the 1950s, the goods sector of our economy was huge. But nowadays, most of our goods economy actually gets imported from China, Taiwan, anywhere overseas. We do not do much goods producing in our country today. And as a matter of fact, I could pull up the charts for it. I've done it in the past. The goods sector of our economy today only makes up 10% of employment. It only makes up 1/3 of consumption. It makes up less than 1/3 of production. It makes up less than 1/3 of investment. And that means that the services sector today is much bigger. It makes up 2/3 of consumption. It makes up 2/3 of investment. It makes up 90% of our employment in our country today. That is a matter of fact. So why does that matter? Well, it matters because, again, it renders a lot of people's recession indicators misleading when they don't consider the fact that things have changed, things have shifted economically. But it also means our economy has become much less interest rate sensitive, where if interest rates go up, it really shouldn't hinder economic growth nearly as much as it has in the past. We think of services producing companies. They're much higher margin. They have less of an initial capital investment. They have much healthier balance sheets. And basically everything to do with those companies makes them healthier than the companies we had when industrial production was ginormous in our country, where margins were razor thin, balance sheets were not good. It took a lot of debt to grow. It took a lot of debt to even start a business. That's a thing of the past now. That's a thing of the past. And again, we can look at the data and see that it's true. Interest rates being at 5% have not really hindered our economy at all. In fact, the goods sector, you would expect it to feel some softness, right? I mean, because it's most impacted by interest rates, but also because of during the pandemic, what did people do? They went out and bought their new furniture. They bought their new home. They bought their new washer and dryer machine, and it pulled forward a lot of demand for goods. And only now have we started to actually recover when we look at goods data. Things are looking up. We have new orders and shipments improving, future outlooks of goods producing companies improving. This is shown in the data. I could pull it up on the screen. But the reason that matters is because the goods sector of our economy, yes, it's been struggling, but it is already starting to bottom and bounce back despite the Federal Reserve having yet to cut interest rates, which will stimulate this goods sector of our economy most. So to summarize all of that, rate cuts are simply additive to an already recovering goods sector. So I think, my conclusion here is a stock market melt-up scenario, the likelihood of that is increasing by the day, and it's up to us to capitalize on this. How do we capitalize on this? Well, I've mentioned over the last couple of months, I think we're going to have some choppiness prior to the election. That's exactly what we've gotten. Before we see a major year-end rally, and I think 2025 is going to be a tremendous year for the risk-on appetite of investors. And there's a few things we can look at in the data. We can look at large caps, mid caps, and small caps and see that small caps operating earnings per share, so the overall profitability of small caps, is still below all-time highs. For large caps, the operating earnings per share have skyrocketed much above all-time highs. That's the red line on the chart. Mid caps are sitting right at all-time highs. They still have underperformed the large caps. But small caps, it looks like that's where the opportunity is right now, where operating earnings per share have actually struggled as interest rates have been higher. This is another area of the economy or the stock market that was impacted by interest rates. The smaller companies, clearly, they will be impacted by higher interest rates because they have a less solid balance sheet. They have to spend more money to grow, and to grow, they probably don't have the amount of profits they need to really grow as fast as they want to, so they have to borrow to grow, or they have to sell shares on the open markets to grow. This is why the small caps, I think, right now are the best buying opportunity in the markets. We can also look at this, and I think when this happens, it's going to take the markets by surprise, and this is when the markets are going to really start to price in or jump into small cap companies. We can see that in 2025, specifically starting in Q2 of 2025, small cap companies are set to outpace the large cap and mid cap companies in earnings growth for the first time since 2021. We all remember what happened in 2021. Small cap companies soared, skyrocketed actually. Risky companies skyrocketed. Think of all the SPACs, think of the Bitcoin mining stocks, things like that. They all skyrocketed. They were the best performers in the stock market by far, and it really holds true. Stock prices follow earnings of companies. And if, again, analysts are correct and small caps outpace the large caps in earnings growth starting in 2025, what are you going to see? Well, when those numbers actually do come in, a lot of Wall Street, a lot of retail investors, they're going to pull their money out of those large caps, or they're going to use whatever cash they have sitting on the sideline and throw it into the small cap companies because people want to own whatever's growing fastest. And if this is correct, small cap companies will be growing the fastest in 2025. We also think of all the money, the trillions of dollars sitting in money market mutual funds, earning 5% risk-free. If interest rates come down, all of a sudden owning those money market mutual funds doesn't look as attractive. People are naturally going to pull some of their money out of that risk-free yield, and it has to go somewhere. Where does it go? It goes to the stock market. So all things right now are looking good for this bull market to continue. I don't see how this will really end. I think the choppiness, again, will continue through the November election, but we'll see a year-end rally, and it might be another quarter or two before small caps really start to be favored again. And I'm okay with that. A lot of people miss the entire point when they come across my YouTube channel. I talk about companies I'm buying today. When I buy a stock, I want to be early. I want to beat everybody else to that trade. I want to beat everybody else to that investment, because if I'm just a part of the flock that flies to whatever asset's hot at any given point in time, I'm not going to outperform the markets. In fact, I'll probably underperform the markets. To beat the markets, which is your goal if you're individually stock picking, you have to beat the markets to whatever the future trend will be. Wherever the future growth is sitting, that's where you need to be prior to everybody else getting there. I made a video on Twitter the other day, which, by the way, go follow me on X. I guess it's X now. Rex_finance. I made a video. You guys can go find it on my profile. I'll show you here. I posted this. If you only ever hear one thing that I say, let it be this: invest like a farmer. A lot of you know I am a fourth generation farmer, technically. Some people that come across my channel will immediately write me off and say, well, you're a farmer. You have no idea what businesses are like. You don't know anything about the stock market. And that's one of the stupidest things you could say. I mean, I've been studying the stock market for 7 years already, and I'm only 23 years old. I do this for a living. I love studying companies, studying how the economy works. It's just something that I'm so passionate about that I consider myself pretty good at it. You know, I'm sure I'm going to be humbled at some point, but you guys know we've had one of the most accurate stock market and economic YouTube channels out there over the last couple of years. You can go back and watch all of my videos since 2022, and we've been on fire with our predictions. But listen to this: invest like a farmer. Farmers don't yell at their crops and remove them when they don't think they're growing fast enough. So don't yell at your stocks and sell them when they're not going up fast enough. People will come across my channel. I'll make a video about stocks I'm buying, which keep an eye out for that. That video will be coming out tomorrow. And they'll come back to my YouTube channel once a month and they'll say, wow, you have no idea what you're doing. That stock pick you had hasn't moved or it's gone down. Do you really think I care? That's what I want to happen so that I can buy more of companies I love for the future going forward. And just because, again, like I say, I'm a farmer. I come from a farm family. We don't yell at our crops and remove them when they aren't going up as fast as we think they should grow. So don't sell your stocks and yell at your stocks when they're not going up as fast as you think they should. Second, farmers don't remove their crops before they've even had a chance to produce something. That goes back to the same point I was just making. Don't sell your stocks before they've even had a chance to produce something for you. That doesn't make any sense to do that. Yet people will go out there and do it because it's the stock market. And they treat these things like lottery tickets. They treat the stock market like a get-rich-quick scheme. And, it's kind of counterintuitive, but the way you get rich quick in the stock market is actually by being patient and having a long-term mindset. It's the people that have the short-term mindsets, the gambling mentalities that will end up losing their money instead of making a lot of money. Anyways, number 3, farmers don't sell to their maniac neighbors who offer them less and less every week for their plot of land that they believe has tremendous potential. So why would you sell shares of a company you own to somebody else that's telling you it's worth less than you think it's worth, or that it doesn't have as much potential as you think it has? Trust yourself, trust your research, trust your own due diligence. When you individually stock pick, by definition, you're saying everybody else in the markets is wrong. That's what you're doing. And you're going against the grain and saying, everybody else, you're pricing this thing wrong. I'm buying right now because I think you have it so wrong. And that's what can make it a long and lonely road. People might call you dumb. People might call you stupid. You might lose money short term, but ultimately that's how you set yourself up to make a fortune of money long term. And then lastly, just like farming, there will be rough seasons. All we can do is be prepared for them. A single kernel of corn turns into 600 kernels of corn with enough nurturing, patience, and discipline. That is the same exact formula for the stock market and investments you make in the stock market. That's the playbook that you have to follow, and we have hundreds of years of history to prove this. Yet people will try and go against this. People will try and say that these sorts of strategies are wrong when we can look at any chart over the last hundreds of years, any data over the last hundreds of years, and it tells us that this is the playbook that works. This is the playbook that wins. Most people won't follow it because they don't possess the amount of patience it requires. Most people won't follow it because it can be boring. Most people won't follow it because you can lose money short term, and people don't like that because people choose to invest money they can't afford to invest. But if you can get over that mental hurdle, you will be so incredibly successful in the stock market, it's not even funny. And that's my goal on this YouTube channel. I think so far we've done a great job of this. We have a great track record on this YouTube channel, and hopefully that can continue. Tomorrow, I will be uploading a YouTube video talking about a few different companies that I'm buying. Some of them you might already know of, but very, very soon in my Discord server, I will be releasing my next stock on my A list of companies that I said I was going to put together for my members and you guys that watch my YouTube channel. Companies that I think have tremendous opportunity in front of them that have been unfairly punished by the higher interest rate regime. You see, all small cap companies have been grouped together and punished the same, despite many of those companies being healthier than others. And that has presented tremendous opportunities that I don't want to miss out on going into 2025. Now, it means a lot to me that you've stuck with me this far into the video. That being said, if you want to go the extra step, I am entirely self-funded. I'm entirely independent, and I always want to be that way. It's my paid monthly members that help support me and help keep this channel going. And you get access to a bunch of awesome perks like early access to my new stock picks, which again, I will be making available to my Discord members very, very soon. And then my YouTube viewers will find out about that a few days later, maybe a week later. We'll see. But if that interests you, consider joining the membership. You can hit the join button located right next to the subscribe button, or you can get my Patreon link in the pinned comment. Again, though, your support, just watching this video this late into the video, means the world to me. But without further ado, even if you don't choose to join the membership, it's completely fine. Stay tuned for that stocks I'm buying video coming tomorrow. And then my new stock pick, I'll make a video on it probably a week from today. So stay tuned for that. With that, have a great rest of your day. Stay blessed. Keep 10 toes of ground on your chin up. Peace out.